To get to the second question in this session, should the firm use more debt? Should it use it more preferred stock, convertibles, common stock, retained earnings? There's all these choices. We are going to limit our discussion just debt versus equity, debt versus stocks, including retained earnings, but we're essentially talking about debt versus net worth. Is there one that the firm should use more of versus the other? This is referred to as capital structure. And we're trying to increase the value of the firm. Can we increase the value of the firm by switching how much we use versus debt versus equity? So remember in your project one, many of you had firms that were borrowing money to buy back stock. So what were they doing? They were shifting from equity to debt. They're using more debt, using less equity. Does that make sense? So debt is financial leverage. Remember, we had operating leverage and financial leverage. Anytime you use operating leverage, which is a lot of fixed costs, if you have a lot of fixed costs in your cost structure, you increase the risk of the company. Financial leverage is how much debt you use. When you increase your financial leverage, increase your debt, you make the company more risky. These are fixed costs that have to be met, whether it's operating leverage or financial leverage. These are costs that you have to pay whether you're having a good year or a bad year. So fixed costs in good years are great because they make the good years look better because your revenues go up, but your expenses don't go up. You don't have to pay your debt holders anymore. You don't have fixed costs for salaries. So your revenue goes up 10%, but your expenses only go up 5%, so your net income goes up greatly. But in bad years, that leverage is terrible. It's going to make your losses much worse. So remember that. That's important. Before we get in here, just very, very important, debt is cheaper than equity, okay? So that's always the case because debt holders, they have first priority claim on the company's assets. So debt is cheaper than equity. If the firm has problems, the debt holders are paid first and equity holders might lose 100%. So debt is cheaper because it's lower risk. So it's lower risk and thus cheaper than equity. However, debt increases the risk of the firm and increases the firm's beta. So that's really, really important. As we get into this, if a firm uses more debt, debt is cheaper, so that's good. So they're moving from, the way to say this is that KD, the cost of debt, will always be less than KE. You might have a finance class where the debate, can cost of debt be greater than cost of equity? But those are really rare and unusual circumstances. The overwhelming majority of the time, the cost of debt will be less than the cost of equity. So that by itself says, well, wow, we should be using more debt because it's cheaper. But if you use more debt, debt increases risk of the firm, and so their beta goes up, and KE increases. So using more debt is cheaper, but using more debt makes your equity more expensive. So there's no free lunch here. So let's get into the theory. But these are the two most important things to remember, and you'll see that with the exam question why these are the most important things to remember. Debt is cheaper, but it increases the risk of the firm. So we're getting to something called optimal or target capital structure. So you can actually go in to Google and type the words optimal capital structure. When you type that in, if you type on images, you'll see images related to this theme, and we're going to use some of these images, and I'll show you the ones I like. Investopedia has a discussion of this. And you look in here, though, they mention Miller Modigliani. They have their names backwards. I don't ever see it Modigliani and Miller. It's always Miller Modigliani. So they talk about it. So this is what I was saying. You could read this, and we'll talk about the pecking order they say here at the end. So there's one approach. You could look at that also in Wikipedia, and they would have the same thing, capital structure, and they'll mention Miller Modigliani. Again, they got it backwards. So I've always learned it as Miller Modigliani, not Modigliani Miller. So it is a huge concept in finance, very, very important concept in finance. So optimal, and by optimal, what we're asking here, optimal capital structure is the same thing as saying, so this is really key to your answer. I'm setting up the most important things. This means minimum cost of capital. That is the same thing as saying minimum WACC. WACC is cost of capital. And this also means maximum firm value. That's what we're after here. The optimal capital structure is the capital structure that gives us the lowest cost of capital. And when we have our lowest cost of capital, we will have the highest firm value. All right, so key terms. So the optimal or target capital structure, obviously the firm's going to target a capital structure that gives them the optimal value, is the mix of debt and equity that maximizes the value of the firm, and that will happen where the firm's cost of capital is the lowest. So Merton Miller and Franco Modigliani in the 50s and the 60s, they came up with this theory, and they did it two ways, or actually probably three ways. But the first theory was if you ignore taxes and bankruptcy costs, let's say you live in a world where there is no taxes and there are no costs of bankruptcy, they said the value of a firm's assets is determined only by the ability of the manager to generate as much cash flow as possible from those assets. Since they say the value of the firm comes from its assets, by simply reshuffling the paper claims. By paper claims, what they mean here is, are you a debt holder that gives you a certain claim on the firm assets? Are you an equity holder, an actual owner of the firm that gives you another claim? By simply shuffling the claims between debt holders and stockholders, you cannot increase the value of the firm. Whether you use more stock or more, oops, sorry, I hit the wrong button there. Whether you use more equity or more debt will not impact the value of the firm. Essentially what they said is capital structure does not matter before taxes and bankruptcy. Obviously we'll have to make the adjustment for taxes and bankruptcy costs because obviously those exist. But ignoring that doesn't matter. Another way of thinking about this is, think of it from a real estate standpoint. Would the value of your house change if you suddenly paid off a large portion of your mortgage? So let's say you have a $500,000 house with a $400,000 mortgage. If you suddenly pay, let's say, $25,000 off of your mortgage, what will that do to the value of your house? This is another way of thinking it. And the answer is no impact. Why? Because the value of your house depends on its location. We'll talk about this later when we talk about relative value analysis. It depends on the location, the quality of the house, what other houses are selling for. Your debt that you have in a house and your equity you have in your house doesn't affect the value of the house. What it impacts is your equity in the house, what your gain or loss is going to be as an equity holder, but it doesn't impact the actual value of the house, the value of the firm, the value of the house is not impacted whether your mortgage is $400,000 or $375,000. So that's another way of thinking about it. So Miller-Modigliani said it does not matter if you ignore taxes and bankruptcy costs. All right, so what if we bring taxes and bankruptcy costs into this analysis? Well, the corporate tax law favors debt over equity because interest expense is tax deductible. When a firm pays dividends, they are not tax deductible. Dividends are not tax deductible. Interest expense is tax deductible. So here's another big part of your answer is that interest expense is tax deductible. So that's going to be a big part of our optimal capital structure. So that's really important. You're going to see we're building up a strong answer here. We call this the interest tax shield of debt. And it's very, very simple. You just take the amount of debt you have times your tax rate, and that's the value. It's a really simple formula. So the value of the firm with debt, that's what I have down here, the value of the firm with debt, the value of the levered firm, levered means you have debt, equals to the value of the firm without debt plus its tax rate times the amount of debt. So let's say right now Alphabet or Google doesn't have any debt at all, and their tax rate is, say, 25%. If they added $1 billion in debt, then Google's value of Google, the value of Google's stock and debt and everything all combined, the value of the firm would go up by $1 billion times 25%, or by $250 million. Same thing if a firm has no debt and its tax rate's 35%, adding $100 million in debt would increase the value of the stock to the stockholders of $35 million. So when debt is introduced, the value of the firm goes up because of the present value of the tax shield. That is, financial leverage increases the value of the firm because of the tax shield, not because debt is cheaper, but because of the tax shield. So before debt, before taxes, this is really, really important. I'm going to type it here, but you'll see it again. Increasing debt moves from higher cost equity to lower cost debt, but the cost of equity rises such that before taxes, the firm's WACC does not change. So that's another important concept. Without taxes, if you don't have any taxes, it's true if you take $100 million and you move that from equity into debt by, let's say you borrow $100 million and you buy some of your stock, you buy your stock back. So you essentially converted from $100 million of your firm from, say, 8% cost of equity to 5% cost of debt. So that sounds good. Man, your cost of capital should come down, but the problem is your cost of equity will go up because you have more debt. And when you do the math, it's actually a mathematical truism before taxes. When you do the math, the firm's cost of capital stays exactly the same. So the value of the firm only goes up. It doesn't go up because you're shifting from expensive equity to cheap debt. It goes up because the interest expense is tax deductible. The firm's value goes up exactly by the tax shield of interest. Now, the last tax law actually changed in 2017, so they reduced the taxes on corporations. So that makes this tax shield less valuable. And at the same time, they put some restrictions on how much a firm could deduct for interest expense. I don't think many firms hit that limit. I looked at the S&P 500 and did not see too many firms that was actually an issue. But the last tax code made this less of a benefit, the interest tax shield. Essentially what you're saying is you can borrow using debt and the U.S. taxpayer will cover 20% of that because it's tax deductible. So there's a good formula right there. The value of the levered firm equals the value of the unlevered firm without debt plus the tax rate times the amount of debt that they had. Now, that seems to argue then we should have everything in debt. We should just like have 1 penny in equity and everything else should be debt. But there's a problem with that. There's a point where you add so much debt, you start having financial distress costs. And financial distress costs is the firm can no longer function because they have so much debt. Any bad news, any recession, anything happens, they're going out of business. They have no flexibility whatsoever. Can you imagine a firm with really heavy debt right now during the coronavirus? It would be terrible. That firm will probably go out of business, and we probably will see some firms going under in this environment, even with all the government, all that our government is doing to try to bail firms out. So financial stress costs, there's direct costs. Your legal costs are going to go up. Your lawyer fees will go up. Your consultant fees, your direct costs. But the bigger ones are the indirect costs. The indirect cost is as your firm gets closer and closer, more likely to bankruptcy. So remember in Project 1, you had the Bloomberg probability of default. As that probability of default increases, the firm is going to have to pay more for its debt. KD is going to start rising, and at one point it's going to start rising really rapidly as their credit ratings go down. They're going to miss opportunities to invest. If they have so much debt, they can't invest. There may be a really great opportunity overseas or to buy another company, but they can't do it because they're just way too levered with debt. And then their operations are going to have restrictions. Employees, their best employees might leave the firm because the firm's in financial distress. Their vendors may not do business with them. The debt holders may put restrictions on them and say, hey, you can't pay any dividends while you're doing this. You can't do any acquisitions when you have this much debt. We're going to put restrictions on you. That's called covenants. Debt holders have covenants that restrict what the firm can do. So these are the costs of financial distress. So you can't just load up on debt to get the tax shield, because at some point these financial distress costs jump in and cause major disruption to the firm. So here's the full theory right here. This is what you need to know. I would actually know this formula and put it on the exam in your answer. Since the exam is going to be open book, it's not going to be difficult to do. So I would definitely put this together, construct it in advance. But the theory says the maximum value of the firm is where you take wherever you maximize the unlevered value of the firm is maximized, remember, just by maximizing the value of those assets. It's increasing your free cash flow. Get as much out of your assets as you can, and then borrow enough that you maximize that tax shield without incurring huge financial distress costs. So there's some point along the line where you're hitting the maximum value of the firm. So you go up, you add debt, you add debt, you add debt, you get the tax shield, but at some point you've gone too far, and financial distress costs start taking over, and you have a major issue. Now, I taught a class once. This is a very specialized finance class. We picked one company, and we did a major analysis of that one company over the semester. And it was the company we picked was El Paso Gas. And El Paso Gas was a firm that had way too much debt. They were in this financial distress. And the management kept saying, our goal is to pay down our debt. Well, the problem was the free cash flows from the company that they were producing was less than what their debt service was. And so they couldn't pay down their debt because they didn't have enough cash flow to pay down their debt. And so our conclusion at the end of the semester was they would need to sell some assets, sell some of their pipelines, do something so they could pay down that debt, so they could get back to a more normal company. A few months, I think it was 2 or 3 months after the end of that class, that's exactly what El Paso Gas did. They sold off their pipelines so they could pay down their debt. The students in that class were ecstatic. It's like, wow, professor, we got it just right. They were really excited. They really saw this. What management was saying was exactly right. They had too much debt, but they had no opportunity to pay down the debt because they weren't producing enough cash flow, so they had to sell assets to do it. If you're more interested, if you're really interested, finance majors especially, we can't get into this with numbers. Undergraduate, the math is just too complex. But if you want exposure to this, email me and I will send you Dr. Damodaran's class, his graduate level class, where he actually works two companies. One's Disney, and I forget what the other one is, where he actually tries to find that optimal maximum point for Disney and this other company. For Disney, he said Disney did not have enough debt, and he was recommending they take on more debt. And the other firm that I can't remember, he said it had too much debt and they needed to pay down their debt. So, next, Dr. Damodaran, if you want his graduate class, he does an entire example of how exactly do the numbers. His key for figuring out if a firm has too much debt is, remember from project 1, we had something called times interest earned. It's not a ratio I like, but that's the ratio Dr. Damodaran uses to figure out if a firm is taking on too much debt. All right, so what we'll do is we will summarize this up, and then the most important thing is I'm going to show you these charts. That's what we'll finish up this class with, is these charts. And what I'm going to do is help you interpret these charts, because I'll give you one of these charts on the final exam, and you'll have to explain this chart in your answer using these key terms that we're talking up here. So I'll walk through how you take all this stuff that we've talked about, but then explain it in a graph. My favorite is this very last one, but the others make sense as well. So next session, we'll finish up this by looking at these charts.